Hey guys, this is the Trading for Dummies series brought to you by Mastermind Trading. Introduction. In the previous video, we looked at the concepts of supply and demand and how these forces of supply and demand move prices in a market. Now in this video, we want to look at how supply and demand is interpreted on the price chart. So basically in this video, we are looking at supply and demand structures and patterns and how they work. It is very important to pay attention to this one concept because in my opinion this is the basis of technical analysis and is the basis of all price action technique. Now, levels of demand and supply on the price chart represent levels of imbalance, and what I mean by levels of imbalance are levels where you have significant presence of buyers coming in and levels where you have significant numbers of sellers coming in. When looking at the laws of supply and demand, we did mention how buyers would want to buy more at lower prices while sellers want to sell more at lower prices, at higher prices. Now, the implication of this is usually when you have, let's say, 50 people asking for a particular item and then you have just one person that is willing to sell that item at that point in time. Now, because of the competition between buyers, prices is going to go up. Not necessarily because that item is more valuable than it should be, but because there's readily too many buyers in the market, that the competition between buyers is likely to drive prices up. And it's the same with on the upside where you have sellers pushing prices down. Now we'll look at how this forms up in the price chart. Levels of supply and demand, or levels of imbalance like I like to call them, are usually identified with four basic structures which we are going to be looking at shortly. The four supply and demand patterns are rally-based rally, drop-based drop, rally-based drop, and drop-based rally. Now, I like to divide these four into a group of two for continuations pattern and then a group of two for reversal patterns. Now, for continuation patterns, we have rally-based rally and drop-based drop, and we'll look at those right now. Now, rally-based rally is a demand pattern, and it is a three or more candlestick formation pattern that usually shows levels of demand. It shows levels where buyers could likely begin to step into the market, and this candlestick formation is usually a green impulsive candle followed by a small sideways candle. Could be a bearish candle, could be a bullish candle, but usually they are smaller candles compared to the size of the preceding candles as well as the preceding candle as well as the candle after that, and then they are usually followed by a strong impulsive candle. Now usually when price returns back to these levels, which are usually marked out as zones, buyers want to look for confirmations to buy that levels into new highs. By that understanding, the rally-based rally is a bullish continuation pattern. The drop-based drop, on the other hand, is a bearish continuation pattern, and it's usually a three or more candlestick formation with a bearish candle, smaller candles to the side, and then a stronger impulsive candles to the downside. And usually sellers want to see prices return back into this base, which is usually marked out as zone, for them to look for opportunities to sell in continuation of the downtrend. Here we can find illustration of both the rally-based rally and the drop-based drop, and both of them getting respected, prices dropping back and then moving on from that point. Next, we have the drop-based rally, which is a bullish candlestick formation, a bullish reversal candlestick formation, and it comprises of three basic formations. First, it is defined by a bearish candle, a drop candle, then followed by a base. And from our definition of a base is usually small sideways price actions in between candlesticks. So then it is followed by a base and then a rally, which is a bullish candle. Usually you will find this when prices is coming from, let's say we are in an uptrend, there's a pullback and then price is trying to reverse from that pullback in the continuation of the uptrend. And lastly, we have the rally based drop, which would usually form up in a downtrend when price pull back to test other significant levels in the downtrend. And then this is usually comprised of 3 or more candlestick formation of a rally, which is a bullish candle, a base, which is a sideways candle, and then a drop, which is a significant bearish candle. This is usually in continuation of the bearish structure. Unlike most traders who like to view at the 4 structures that we have identifying levels of supply and demand, I personally only look at 2 structures, 2 supply and demand structures, which is rally based rally and drop based drop. While I consider this to be the significant levels where we have significant numbers of buyers and sellers, where we have huge imbalances that can push prices in the direction that we want them to be. Now, drop based rally and rally based drop, in my opinion, are structures that forms to take out levels of supply and demand, while rally based rally and drop based drop are structures that create these levels of supply and demand. So I like to approach it that way. I like to only trade off rally based rally and drop based drop. And from what you find here, you will notice that whenever a rally based rally and a drop based drop is identified on the price chart, when market returns back to take out that level, it will usually do that with either a drop based rally or a rally based drop, as the case may be. We'll look at this in further illustrations. So guys, that's it for now. I remain Monaco Daniel, the mastermind trader from the world's most populous black nation. Peace out.